I'm Greg Hunter. Welcome to USAWatchdog.com. A real treat. Listen, the price of gold, I stand here, is over 1,800. It's been over 1,800 for a while, plus or minus a few bucks. Silver over $19. But we still have a mismatch in the gold to silver ratio. I mean, it's about 90 something ounces of silver to equal 1 ounce of gold. And to come on and explain what's going on with gold and silver and the pricing and delivery and who's got it and who does it and who's exposed and where the price is going is Alasdair Macleod. Alasdair Macleod, gold expert extraordinaire. Alasdair Macleod, thank you for joining us today on USAWatchdog.com.
That's my pleasure, Greg.
Okay. Listen, good to have you on. We have 1,800 plus gold thereabouts. We have silver above 19, which is almost stunning after all the naked short selling and smashing down. Overall, what's going on in the gold and silver market? Again, I just want to start with this right off the bat. Are we getting close to one of these non-delivery events to where there's going to be a big buyer not get a lot of gold or silver? Are we getting close to that kind of an event?
Well, we could well be, because there's a lot less physical liquidity than is generally understood. We saw, for example, the LBMA produce statements in March about how much gold they had in their vaults, in their members' vaults. But actually, when you looked at it, most of it was Bank of England, held earmarked for other central banks. On top of that, you had big lumps of ETF gold. You have privately owned gold in vaults like Loomis and Brinks and so on and so forth. The real liquidity was at that stage probably less than 1,000 tons. And now I would think that it's probably down to somewhere under 500 tons. So that's London's liquidity. Now, this becomes quite serious when on COMEX you find that when an active contract rolls off the board, suddenly huge amounts are being stood for delivery. And I think on the June contract, which was the last active contract, something like 171 tons was delivered from that contract running off the board. And what's very interesting is that the current active contract is August, and that runs off the board in the next 2 weeks. We're beginning to see it roll from the previous into the current. From the August contract into the next active contract. So already the roll is beginning. But the big question is going to be, at the end of the process, how much of that is actually going to stand for delivery? Given the very low level of physical liquidity in London, you can see why the exchange for physical isn't really working all that well. It could actually create a crisis. And particularly when you look at the composition of the shorts on COMEX. I mean, there are two categories of short, basically, net short. One is the swaps and the other are what's called producers and merchants. Now, in a normal market, there is some balance between these two categories. But on the last commitment of traders figures, it was clear that the swaps had 72% of the short positions on the non-speculative side, with the producers merchants, who would normally run at somewhere between 40 and 50%, they're down to 28%. Interestingly, on the other side of the equation, if you look at the speculators, the managed money category are long, yes, but they're not that long. There's something like, I suppose, 15,000 contracts over that average long-term position in the longer run. But what has happened is that the two other categories, other reported and non-reported, and these basically are people who don't fit into the precast categories, if you like, of managed money, swaps, producers, merchants, and so on. These guys, the other reported and non-reported, we're looking at family offices, we're looking at rich foreigners dealing over Globex, for example. These are the guys who, it seems, are standing for delivery. And at the moment, they are comprised, the other reported are 39% of the longs, and the non-reported are 16%. The managed money, which is normally up to 70% in a bull market or in a bullish phase, are only standing at 45%. So you can see the makeup of this market is extremely dangerous as far as the bullion banks, the swaps, the trading desks, if you like, of the bullion banks, as far as they're concerned, this is a very dangerous situation. And I find it difficult to see how they can close it. I mean, we were talking earlier, and
when you say dangerous that you could have a price explosion, that you'd have people defaulting, people going out of business. Explain extremely dangerous.
Well, the possibility of a default and the possibility of, let's say, a force majeure being declared, I think is increasing all the time in this current situation. Obviously, it's a difficult thing to predict, but unless someone can show me there is a way out of this, like the Bank of International Settlements comes in and has another crack at it, like they did back in March, which failed, incidentally, then I can't see how these banks can be rescued. And the other problem that the dealers on these desks...
I'm sorry, hold on. Yeah. Hold on. I just want to come back here for it. So, in other words, they can't reel it back in. They're stuck. They're stuck with either they got the short, they made their play, and they've got to deliver the gold, and they may not be able to.
This is the situation now. So yes, that appears to be it, and it's very difficult to see how they can get out of this.
So the only thing that can save them is they need to roll out on the loading dock tonnage of gold they don't likely have.
Which they don't have. Not likely have.
They don't have.
Yeah.
Ooh, boy.
Exactly. And I mean, traditionally what happens is that the central banks come and help out the market by leasing gold into the market. But the lease rates are negative. So there's no incentive for them to do that. And not only that, in the current environment where central banks are printing money, particularly your central bank, printing money in huge quantities, there is no incentive at all for a central bank to part with possession of its gold on even a 1 month or 2 month basis. Well, it doesn't actually, with a lease, it doesn't actually part possession. But the money cost of a leasing rate which is negative is a great disincentive to providing the liquidity.
So you're saying that this keeps going in the way it's going. At some point, somebody's going to have to come out and say, "We don't have the gold."
Yes, and the way in which the market, COMEX, deals with this is it declares a force majeure, which means that everything gets settled in currency, not bullion.
How many times can they do that? I mean, how many times can they come out and say, "Oh, these guys don't have the gold. Okay, sorry, we're going to pay you in cash." Do you not have a market after that?
I think it would be the end of the market. It would be the end of the futures market, because nobody would then trust it as a means of delivering gold. I mean, it would demonstrably have failed. So why would you play with it again? And of course, the failure of COMEX futures contracts is a very, very serious issue. And it's not just gold. We're talking about a situation where the employers of these gold traders, a bullion bank is actually the division of a larger bank. They're giving trading limits, and these trading limits, they're trying to cut them. I mean, management has got liquidity problems as it is, and the way they try and deal with the liquidity problems is they turn around to the traders on gold, on foreign exchange, on derivatives, swaps, whatever it is, and say, we're going to cut your position. Okay, you've got a position limit of $50 million. So I'm going to cut that. We've got to cut that down to 25, and we want it done quickly. This is the pressure that these guys are under from the other side, which of course we don't normally see. But that's what's going on in the banks as a whole.
And some people are of the mind that they're saying that they can just settle. They can just settle in cash, And Craig Hepke came on a while ago and says, no, they cannot. No, they could. Not anymore. They turned it into a delivery mechanism. Is that your finding too, that they basically are stuck delivering at this point? They better have it if they short it, or they're going to do this force majeure thing, and that's the last time they get to do that one time?
That would be it, in my view. I mean, I can't see how...
I let that sink in. So yes, they can settle for cash. Yes, they can say, yeah, you're not going to get your 2, 3, 5, 10 tons of gold. We're going to pay you in cash. And then that's the last time that happens? In other words, so the market goes haywire at that point.
Yeah. If you look at the conditions behind a contract, you will find in the small print somewhere down there that in the case of a market failure, the COMEX can declare force majeure on that contract, which basically means that the contract has to be settled in cash, not through delivery of the physical.
And what happens when that happens? What happens if COMEX comes out and finally says, we don't have the gold? Sorry.
Well, it's very much last resort. Now, I would think that the first thing that COMEX will try and do is negotiate with the government, your government, maybe other governments, to try and find some liquidity in order to deliver against this contract. But, as I say, with negative lease rates, I find it difficult to see that they'll get the cooperation required to do this. And we've also got the problem that the underlying background is so inflationary. Monetary inflationary, I mean, the amount of money per unit of gold is just going up all the time. And so it means that the market, the physical market, is just getting tighter and tighter and tighter. There isn't the liquidity to deliver into this market. So I just don't know how it is going to be resolved. The only thing I can think is they will have to, at some stage, if this continues, fall back on a force majeure clause within the contract, and basically that forces everyone to deliver in cash, not physical.
What happens to the price then?
Well, I mean, the price is already on its way to infinity, or put more accurately, the dollar is on its way to zero. So the question really, I think you want to know the answer to is how long will that take? And in my view, not very long, probably by the end of this year, because we've got another thing happening in the background, Greg, and that is we've got a banking crisis developing, which is the natural consequence of the contraction of bank credit, the effect of tariffs on top of that, which turn a normal cycle of bank credit contraction into a 1929 to 1932 horror show. Under those circumstances, the next thing that happens is that, I mean, let's assume all the banks are rescued. All those liabilities, bank liabilities, go onto the balance sheets in effect of a division of the government, whether it's the Treasury or a central bank is immaterial. So that has to be paid for by inflation. The value of all the assets acquired by nationalizing or taking over control or underwriting the banking system goes to pot, because you've only got to look at where the market is, equity markets are, and what's actually going on in the real economy to understand that it's wildly overvalued. It is only there because of the money being puffed up. If you have a banking collapse, then those assets, the financial asset values, will just go down the pan. And the next thing, of course, is that bond yields start rising because of the inflationary implications of a financial collapse. And at that stage, government financing becomes impossible. Government's in effect bankrupt. So what we're seeing is that, cutting the long story short, because the central banks have tied in their currencies to supporting financial asset values, come what may, one goes, they both go. And I think on that basis, I mean, the last time this happened was John Law in France in 1720. He tried to continue to support his Mississippi bubble in the early days of 1720. And by September, there was some notional value in the shares, but the currency had no exchange quotation in London. The livre was worthless within six months of the bubble bursting. And that looks to me to be the closest historical comparison with the situation we have now. John Law was France only. What we have now is global, and it is centered on the reserve currency, the dollar.
And you're thinking that the stocks and the currency go down together, and the bonds.
That is the lesson of history, and I can see
and this
exactly
is going to be
how
like
it
on
happens.
steroids. This is like,
Yeah.
And the derivative complex, the hundreds of trillions, the cartoon world we live in derivatives. What happens to that?
They go too.
What happens to all these pensions? Is that another poof? Do we just have a bunch of poof? Everything just goes away.
Basically, if you destroy the currency, you destroy all the financial assets that are priced in it. I mean, that just happens. It just goes. Now, in corporate equity, I mean, some companies will survive this sort of situation intact. I mean, I could obviously mention the miners, who will be always slightly ahead of the game in terms of the value of their product compared with their costs of extraction. So, things like mining companies will survive. Now, at some stage, the pricing of mines will have to move from the dead currency into a new money or new currency. And this is why people are talking about a reset. Everybody knows this is going to happen, but they don't quite know how it's going to pan out. And they're saying it's going to be a reset. But a reset is something which a government will organize. But actually what has happened is that the people have turned around and rejected the government's money. So I don't think a reset in that sense is very easy. If, on the other hand, they were to back their currencies again with gold or silver, then you have a chance that your currency will survive. But you also have to cut public spending hugely. I mean, you can't just say, right, we're going to declare a gold exchange standard. No, you've got to alter what your government does, the scale of its commitments, to ensure that it always balances its budget and to ensure that the private sector can accumulate wealth. And that basically means that government has to get out of the way.
And I want to come back to what you said, which I didn't want to interrupt you. You're on a roll. Is that you think there's going to be a force majeure, a non-delivery event, which will explode the gold and silver market? And I want you to talk a little bit about silver. I know that's not your wheelhouse, but it's right along with gold. It's it's crazy, cousin, silver, in a good way. But you're thinking this is going to happen before the end of the year.
I think the destruction of the currencies is going to happen by the end of this year. The problems on COMEX are obviously going to be considerably before that, and I think are probably going to be tied in with a wider banking crisis. A banking crisis is almost certain, Greg. I mean, I cannot see how it can be avoided. You've only got to look at the relationship between the balance sheets on a Eurozone globally systemic important bank, well, the GSIBs, to its market capitalization. In the case of Societe Generale, it's 100 times. I mean, can you imagine it? 100 times.
And then you have Deutsche Bank, that wart on.
Yeah. Well, Deutsche Bank isn't as bad as that. Deutsche Bank at the moment is about 60 because their share price has roughly doubled in the last couple of months. Commerzbank, another one. Now, that's not even a GSIB. That is a major bank, which isn't a GSIB. And even that has problems. And we haven't even started talking about the other French banks, the Italian banks, the Greek banks, the Spanish banks. I mean, it is a horrid mess. And what worries me in London is our exposure to this. Our exposure to this in London is enormous. And we've got another exposure, and that is HSBC and Standard Chartered, whose business is very much in the Far East, very much tied to China. And at the moment, we're turning around and telling the Chinese, we're with the Americans, not with you. So, how's that one going to pan out? We've got a lot of banking risk around here. And I mean, funnily enough, the only banks which are best capitalized really as a whole are the American banks. But the reason for that is that if you look at this comparison of market cap to assets, your market caps are roughly book value for your banks. It varies a bit above, depending on the bank. But broadly speaking, you're looking at book value. In Europe, we're looking at 20% of book value, and that's the difference.
Oh, boy. And so with this background that you think, you said banking crisis almost certain. Well, it sounds to me pretty certain. You think we're going to get a banking crisis?
Yeah. I mean, I can't see how it can be avoided.
Okay. And so there's not so. And Hemke brought this up, and I want to get because you don't talk to Hemke at all, and he says if the only thing is if the demand keeps up the way it is now with silver, he was doing silver and gold, and he says that there's no way it doesn't fail. There's no way if they keep the demand going. Is that what you're saying? If the demand keeps going with this massive money printing, I mean, the Fed balance sheet's a cartoon. It went from 3.7 trillion to over 7 trillion, going to 10 trillion. I mean, even Dudley, the former Fed president in New York, we're going to 10 trillion. I mean, So if the demand keeps going with this massive money printing, this is a lead pipe cinch. We're going to get a failure in the gold and silver markets for physical delivery. Is that your contention?
Yeah, it's pretty much inevitable. I mean, you've got to think, Greg. If I'm right about a banking crisis, and if I'm right that that is going to implode the value of financial assets, then one thing is absolutely clear: the currencies are on the line as well. And that basically means that their purchasing power goes to zero. I think it'll be by the end of this year. I'm going on historical precedent from the one time it happened before, and I can see how it happens. Okay, I won't go into that because that's quite a technical debate.
Go ahead.
But if our end point is the purchasing power of the dollar goes to zero, then you can see that $1,800 for the price of gold, $19 for the price of silver is chicken shit compared to where it's going to go. So this is a major move that is happening, not because people are buying gold and silver so much, but more because they're beginning to realize what is happening to the purchasing power of the dollar, the pound, the euro, and so on and so forth. That is the thing to keep in mind. Now, whether the markets, the financial markets, can navigate through that without having some sort of catastrophe like force majeure or systemic issues being multiplied, it's quite difficult to see how that can be the case. And here we are looking at gold and silver. Now, silver, if I can just switch on to silver for a moment, silver is actually a very different situation from gold because the swaps, in other words, the bullion bank trading desks, are just slightly more than average short. I think they're short about 10,000 odd contracts, a figure like that. The managed money, which basically are hedge funds, are just slightly more than normal long. So, what the bullion banks are trying to do here is just not get into difficulties. And I think that's why we saw such a sharp rise at one stage in the silver price yesterday. I mean, it was up 3% intraday. This, I think, is banks, if you like, effectively backing off from selling liquidity to buyers. And if they back off, then, it could easily get to $20 in a heartbeat.
That's what Hemke says, that they'll just either stop shorting it, or they're going to get hammered and deliver it. So they're going to have to just pull back, right? And that's what you're saying.
Exactly.
So that when they pull back and they stop stepping on it, the price has got to go up.
Yeah. I mean, basically, they have pulled back from making a proper market in the silver contract. The silver contract's never been all that liquid anyway, certainly compared with gold. But where they've really got the problem, I think, is in the gold contract, the GC contract on COMEX, because, the short position, I was calculating it out earlier on, the short position has now risen to over $37 trillion worth, 37.6 net. The gross, if you take out the longs, 50.7 trillion, billion dollars gross. So that's $50.7 billion gross, $37.6 billion net. That is the total short position that the swaps have in the current market at current prices. So you can see just how disastrous this is for them.
They can't come up with $37 billion in gold.
No, they can't do that, and nor, so far as I can see, having had an attempt to shake the market earlier this year, when they got open interest down from 800,000 down to around about 470,000. The gold price initially went with it, and then it started rising while the open interest was falling. And they ended up in that operation, the swaps ended up more short in terms of money value than they had at the start of it. So they completely failed as an attempt to try and clear out the market and get balance back into it. So I don't know what tricks they've got left in the book. If the US Treasury came out and said, right, you can have 8,000 tons of gold, whoopee, that was sorted out. But is that likely? I don't think so. So, this is a real problem, So you'd be a buyer. I asked this to Nomi Prince about $1 ago on silver and about $50 ago on gold. And I said, so you'd be a buyer right here. And she's, yes. And she's not really a gold person. She's just like, yes, with all the money printing, it basically,
She said, yes, I'd be a buyer right here because, they've told us they're going to blow up their balance. They've told us they're going to explode their balance sheet. So,
exactly.
So you'd be a buyer right here. I mean, this is a no-brainer. I mean, you would just,
if you could get it. It's a complete no-brainer. I tell you, Greg, I run my life in gold. I have as little fiat as possible. And since the end of 2015, this has actually worked extremely well for me. Thank you very much. And I see no reason to change my approach to money at all. I mean, I just release whatever money I require from gold into fiat in order to cover my day-to-day spending. And that's the only relationship I have with fiat.
How can people find you? You're a pretty prolific writer. How do people find you? How do people follow you?
Well, I'm head of research for Gold Money.
That's right, with James Turk.
That's
is Turk still in the? Is Gold Money? Yes. Is Turk still in? Okay, good. I like him. He's a great guy. He's a fantastic. Go ahead.
Absolutely. He really is, and very knowledgeable too. Actually, I mean, he sort of hides his light under a bushel a bit, but he is extremely knowledgeable. So I'm head of research for Gold Money, and that's goldmoney.com. And if you go to the website, you'll see the normal sort of menu at the top, and under research you'll see insights. I write a weekly insight which is published on Thursday afternoon EST time, and I do a market report on the Friday, which your viewers might like to see as well, and that again comes out in the afternoon EST time.
Some people are like, they tell me, because why do you follow gold so much? Well, let's see here. It's now a tier 1 asset. Every central bank, it not only holds it, has been buying it, while they tell us it's a worthless piece of junk. So I think it's at the center of the monetary system, along with silver. And so that's, why. And what do you think, and I don't want to get crazy here. Where do you think the prices for gold could go? And we're talking, this is soon. This is months away, not years away. Where do you think gold could go? Where do you think silver could go by the end of the year?
Well, given that I think that the dollar will be destroyed by the year end, the answer for both is infinity. Because that's actually what we're talking about. We're talking about the value of the dollar, not gold. The point about gold is gold and silver are money, and they will return as money when fiat currencies have gone. And you better have some. So, what I've been doing recently with 100-to-1 silver-gold ratio is I've been acquiring some silver coins so that I have got some money to spend, which is not gold, if you like, which is the big stuff, in my hand in case I'm right. It's an insurance policy, if you like, in case I'm right. I hope I'm wrong, but I'm finding it very difficult to see.
Given the numbers, you're on the other side of the ocean. You're basically come up with the same premise. I know you and Hemke don't talk to each other. It's the same premise. They're going to get caught. They're going to have to deliver. The price is going to blow up, and then people are like, they could just settle the contracts in cash, and they could do it one more time.
They could do it once, basically, and I think after that the market's finished. I really do. I cannot see how the market would ever have the trust of its users again. And quite honestly, if we're talking about a banking crisis, and I think you and I have agreed that this is inevitable, if this happens soon, then there is no COMEX, because all derivatives go. We're talking about the whole banking system.
Nobody would sell their gold or silver. Nobody.
No.
They would just go, no.
Yeah.
I'll wait, maybe next month.
Yeah.
Let's see how this sells.
And not only that, but the central banks themselves have been accumulating gold. And are they going to go and lease them to, make the thing easier? I think it's getting more difficult for them to do so. Central banks do cooperate with each other. And I'm sure that the Bank of England will sort of say, come on, we must have some help. But I think central banks are now beginning to think we've actually got to protect ourselves.
Yeah, I was going to say, when do we hear every man for himself? Because isn't that going to happen? They're going to look at them. Hey, Bank of England, you've got a lot of gold. Yeah, no. Right?
I think it's happening. The first sign we saw of this was Germany repatriating its gold, and that was followed by the Netherlands. We have seen Russia get out of dollars, go entirely into gold. We see all the European, certainly middle European countries. I mean, okay, it's not significant, but you can see which way they're going, like Poland, like the Czech Republic and so on. You know, they've all been buying gold as and when they can. And I think that's a clear signal that they see the dollar is basically toast. They're not really going much further than that in their analysis, I don't think, but they can see that the dollar is not fit for purpose. And remember, was it 2 years ago, Mark Carney at the Jackson Hole conference said, you know, the dollar is no longer fit for this world because it has moved on. You know, this is not a dollar-centric world anymore. We've got China, we've got the whole of Asia. All these countries are now emerged, if you like butterflies from a chrysalis. And, you know, it's a different world. It's not one for the dollar. We need to address that issue. And I don't agree very much with anything that Mark Carney says, but I think he hit the nail on the head. And the reason that he was able to do that was he was actually retiring as head of the Bank of England. So I think he felt you know, that much freer to speak.
What do you make of this coin shortage here in America? I have a theory, and the theory is that's a treasury instrument, and the banks are hoarding the coins because that's a treasury instrument. It won't be devalued. And I don't know, you know, it's not like a Federal Reserve note. I could be way off base, but what do you make of the coin? All of a sudden, we have a coin shortage. What do you think about that?
Well, quite honestly, I haven't followed it,
okay,
Greg,
all right,
so I haven't really thought about it. I don't think I can add anything to it which is of value.
But what we do have is a coming banking crisis, and we do have a coming seizure in the markets, and we do have a coming kiboshing of the. They're going to have the dollars. They're going to have to come up with a new dollar at some point.
Well, yeah, I mean, there's the Treasury dollar, which you know, people have been talking about, or some people have been talking about. But you know, unless it's actually backed by gold, I mean, forget it, because you know, it's just the same as the Fed dollar.
And Donald Trump brought this up on one of his speeches at Tulsa. Actually, he says, you know, Germany owes us $1 trillion. Nobody even asked him a question about that. I said, wait. Germany owes us $1 trillion. Is that going to be used as leverage? Remember that gold you didn't get back? Yeah, we're going to keep that. You owe us $1 trillion.
Well, I don't know whether that's true or not. I mean, that Germany owes $1 million.
That's what the president said. I heard him say it. Germany owes, because of NATO, Germany owes us $1 trillion that they didn't.
Yeah.
I don't know.
I mean, that I think would be a very, very bad move. I really do think that would be a very, very bad move.
The press is so stupid over here that they Germany owes us $1 trillion. What does that mean? Nobody asked him a single question about it.
Yeah, it's crazy. That's crazy. I mean,
he had a reason for saying that. He's not crazy, but he had a reason for saying it.
I think. I mean, what's interesting is that.
I mean, what I was getting at is part of the reset. Sorry. Go ahead.
Well, I don't actually see that. That I don't see. I don't think that's part of a dollar reset. But what could happen in the scenario which I've just described is that Germany could come out of the euro and form, if you like, a sound money fortress, including a few others like the Netherlands, to join them with a sound money European base. Now, France has got a lot of gold. Italy's got a lot of gold. Those two probably don't have the necessary fiscal discipline to ensure they continue to run balanced budgets. If they did that, then they could join in with that. It would mean the destruction of the euro, which under my scenario is going anyway. But I can see that at some stage we could have the makings of a sound money system in Europe, led by Germany. Now, I look at President Trump's comments, which you've just repeated, in that light. It would be a spanner in the works. I mean, it wouldn't kill it, but it would be definitely a spanner in the works, and it would do US-European relations no good at all.
And you think that we are in the process of this reset right now? We're seeing the reset working its way out in all of its ugly machinations, and at the tip of the spear is gold and silver. They're going to be majorly a part of this reset of all this debt that we're never paying back globally, right?
Well, yeah, we haven't started with the reset yet, but I think at some stage, obviously, the central banks are going to try and come up with a way of doing this, perhaps without gold and silver. Now, whether they've got time to do this, I mean, for example, one of the things they're looking at is digitizing their currencies, turning into a sort of centralized cryptocurrency type thing. It takes a long time to get that sort of new venture on the road. I don't think they've got time to do it. And I think the collapse is likely to be so rapid that in the absence of any other information, the best thing to do is to hold on to gold and silver as an insurance policy, just in case I'm right.
And you've been right a lot. You can find him at goldmoney.com. Alasdair Macleod, as I said, a gold and silver expert extraordinaire. Alasdair, thank you for joining us today on USAWatchdog.com. I didn't realize the fuse was so short this year. This year, big fireworks this year.
I believe so. Yeah.
And maybe by the end of summer.
Yeah. Well,
in COMEX.
Yeah. I mean, yes. I mean, if we're talking about the banking crisis, I think within a month, quite possibly. So, I mean, just think what's happening to their balance sheets with nobody, everybody locked down and maybe going into a second wave. But we'll put that to one side. And we forget that before this virus happened, we were already descending into crisis. So,
good point.
Do you remember repos?
Yeah.
10%?
Yeah.
The liquidity crisis is already there. You could say that we are already in the banking crisis, and the only reason it hasn't emerged is because of the liquidity that is being provided for the banks to keep them going. So, yeah, it's. I'm afraid it is upon us.
Something like 35% of people with mortgages and rents aren't paying. They're not paying.
Yeah.
I mean.
Yeah. Absolutely. And in a sense, if everybody's not paying, why should I not pay? Or why should I pay rather? I mean, there is safety in numbers. There's the old adage that, you owe £1 million to the bank. I mean, they put it another way. Originally, it was you owe £100 to the bank, you got a problem. You owe £1 million to the bank's got a problem. And I think we're getting to that point.
Yeah. Alasdair Macleod, thank you for joining us today on USAWatchdog.com, the website goldmoney.com, the brainiac of that enterprise, along with James Turk. Thank you so much for joining us today on USAWatchdog.com.
That's my pleasure, Greg.